In this video, we'll look at a way of potentially increasing the return on your investments without increasing their overall risk, a technique called return stacking. This is a technique that uses leverage to invest your capital more efficiently to boost both return and diversification. So how does this work in practice? What ingredients are required to do it? And what could go wrong? Today's video is sponsored by WisdomTree, one of the leading ETF providers globally. To understand why return stacking is useful, let's start with the 60-40 portfolio and why it sometimes doesn't work. Now, for many years, people have used the 60-40 portfolio as the core of their investments. Maybe it's not 60% equity, 40% bonds in your case, but it's some variation of that, maybe 70-30 or 80-20, or perhaps 100% equity. But it's now possible to build that core very cheaply, and that's what many people do. They combine a global index fund with something safe like a money market fund, a gilt ladder, or a global bond fund, and then they dial up and down the equity component based on their risk appetite, their risk capacity, and their investment horizon. Now, it doesn't usually end there. Many people have a fund portfolio, you can also call it your satellite portfolio, where you try not just to buy the market, which is what the core's achieving, you try and beat the market. And many people's portfolios can be characterized in this way. The core, where you do the very simple stuff, where you simply benefit from the long-term increase of markets, and you do that with fees as low as possible, and then you have some fun trying to beat the market, often failing, it has to be said, but that's the satellite investments. Now, key to understanding that portfolio is that if you do have more risk in your portfolio, i.e. more equity, long term, you'd have had a greater return. That's been true for many decades. It's not true for all investment periods, particularly short ones, but here you can see it in practice with the life strategy funds from Vanguard. These have been around since 2011, and notice how Life Strategy 100, which is 100% equity, has massively outperformed the other funds. Having more bonds in your portfolio meant less return, although it did come with lower volatility. So over this period, Life Strategy 100 achieved a return of about 10% per year, whereas Life Strategy 20, which is only 20% equity, 80% bonds, has a return of just under 4%. Now, the reason why many people have bonds in their portfolio in the first place is not because of that long-term return, it's because they're worried about what can happen over the short term. So let's look at the pullback in markets in 2020, which is what you can see here. And I've shown those 5 life strategy funds during that period. And sure enough, you can see that if you had more bonds, you'd have lost less money over the sell-off period. Life Strategy 20, which is mostly bonds, would have fallen just 5%, whereas Life Strategy 100 would have fallen 25%. Now, bonds do hedge equity, but not always. If it is the case that we have a spike in inflation, or there are worries about a US debt default, then both bonds and stocks fall together. The inflation spike in 2022 essentially created this high correlation between equities and bonds. Both fell together, and as a result, the hedge, the ability of bonds to absorb losses from stocks, broke. So from December 2021 to December 2022, notice what happened to the life strategy funds. Everything was reversed. Life Strategy 100, which is supposedly high risk, only fell 6.8%, whereas Life Strategy 20 fell by 17%, and it took a lot longer to recover. Now, what you could do is mix in some other investment in there. For example, many people use gold as a third asset type because that would have held up during this sell-off in 2022. However, the long-term return of gold is roughly in line with inflation, i.e. a zero real return. So perhaps there's another way of structuring our investments such that we can still have this 60-40 core, but somehow add an additional return and also diversify our portfolio without having to sacrifice some of our capital. And that brings us to return stacking. Now, the definition of return stacking is that it involves layering one investment return on top of another, but in order to achieve that, you get more than £1 of exposure for every £1 that you've got invested. Perhaps the best way to illustrate return stacking is diagrammatically. Here you can see a traditional 60-40 portfolio. We have £100 to invest, £60 goes into equity, and £40 goes into bonds. The idea behind return stacking is that we don't have to use all of that £100 to get that 60-40 exposure. What we can do is to get 1.5 times levered 60-40 exposure. Then we'd only need to invest 2/3 of our money, £67, into that 60-40 portfolio. What that means in practice is that we'd have £33 left in order to invest in something else. And whatever we invest in would ideally be uncorrelated with a 60-40 portfolio. So that, for example, could be our commodity investments. It could be gold, or a combination of gold and other commodities, say. Now, a key point here is that return stacking is not the same as risk stacking. While we did leverage up the 60-40, we only did it 1.5 times, and we dialed down the amount of our portfolio invested in that. So overall, it's equivalent to having 100% in 60-40 in terms of risk. And if we're careful about how we invest the remaining third of our portfolio, such that it's uncorrelated with a 60-40, that should reduce our overall risk. Now, if you want to understand return stacking in more detail, I don't think there's anyone that does a better job of explaining it than Corey Hofstein. This is taken from one of his company's white papers on return stacking. And again, here on the left-hand side, you can see that 60-40 portfolio. It's got treasuries and it's got equities in it. But then the bar chart in the middle is the capital efficient implementation, or return stacking. Now here we've got the same 60-40 exposure, but it's levered, so our overall notional exposure is more than 100%. The amount of capital invested is the same, but notional exposure also considers what happens with leverage. Now here the additional investment is cash. We haven't invested the additional cash, but on the right hand side we've invested it in corporate bonds, investment grade corporate bonds. Now here you can see a backtest of those two strategies, the one on the left, the traditional 60-40, and the one on the far right, which was a combination of leverage 60-40 and investment grade corporate bonds. And this tracks the two strategies from the period 2001 to 2021, a 2-decade period. And the outperformance of the return stacked strategy is considerable. Its return was 7.7%, whereas the return on the vanilla 60-40 was 6.9%. Now, did we take a huge risk in order to achieve that? Actually, no. The volatility of the return stack portfolio was only slightly higher, 0.3 percentage points, than it was for the 60-40. So we've achieved a 0.8 percentage point increase in return with a 0.3 percentage point increase in risk. And that is why return stacking is interesting. Now, I've been watching Corey's videos and listening to his podcast for a while, and it was always quite frustrating because in the UK you couldn't implement something like his strategy. And that's because you couldn't get a leveraged version of the core in order to do the investments. However, that's recently changed. And that follows the introduction of WisdomTree's Global Efficient Core Exchange Traded Fund. So the key ingredient in return stacking is this leveraged core allocation to a diversified global portfolio. In the UK, the WisdomTree Global Efficient Core UCITS ETF provides 1.5 times levered exposure to a globally diversified 60-40 portfolio, i.e. 60% large cap global developed stocks and 40% to developed market government bonds. And that's via the bond futures market. If you've noticed that 90% and 60% add up to more than 100%, you're not reading this page incorrectly. The ETF provides 90% exposure to large cap global developed equities and 60% exposure to global government bonds. These add up to 150% because of the 1.5 times leverage of the ETF. But usually you would not buy this fund on its own. The power of return stacking is that you buy this ETF alongside others. So let's say that you have £100 to invest. By investing 2/3 of that in the 1.5 times levered Global Efficient Core ETF, that's equivalent to investing 100% in a 60-40 portfolio. Then you have 1/3 of your portfolio to invest in other things that add additional return to your portfolio. Ideally, these would be uncorrelated with your core because you want to stack return, not risk. In this illustrative example, we use a combination of 18% in broad commodities and 15% in gold. The line at the top is the illustrative return stacked portfolio, and the line just beneath it is 100% stock developed market index, in this case MSCI World. Notice that the illustrative 60/40 portfolio return is significantly lower than the illustrative return stack portfolio. But as investors, we don't just have to think about return, we also have to consider risk. Investments are a trade-off between risk and return. When comparing investments, an important question we should ask ourselves is how many units of return we've received for every unit of risk that we've taken. If we use the typical annual percentage price move or volatility of our investments as our risk measure, then we can divide return by volatility to get a risk-adjusted return, or Sharpe ratio. Notice that the Sharpe ratio of our illustrative efficient core model portfolio is higher than that of the illustrative 60/40 portfolio. In other words, the return stack portfolio gave a higher return for each unit of risk that we took over this 25-year backtest period than the 60/40 portfolio alone. The WisdomTree Global Efficient Core UCITS ETF trades on the London Stock Exchange in two currencies, US dollars with a ticker NTSG and pound sterling with a ticker WGEC. Personally, I'd usually use the sterling denominated version of the fund because then I don't have to pay for currency conversions on my investment platform. More information about this product and the applicable risks can be found in the link in the description below. So in that example, we looked at return stacking a 60/40 leverage portfolio with a combination of gold and broad commodities. But what else could we stack? Well, these are the criteria to consider. The first one, possibly the most important consideration, is that whatever you choose should ideally be uncorrelated with the 60/40 component. And that's because what we don't want to do is to stack risk as well as return. The reason why the risk-adjusted return of the return stack portfolio was greater than the 60/40 portfolio was because of that diversification. Ideally, whatever you choose should also be a steady generator of return, ideally a return that's as large as possible, and ideally a return which is greater than inflation by as much as possible. Also, that return has to exceed the risk-free rate, because that often is the cost of the leverage which is built into the 60/40 portfolio. Now, Corey Hofstein often refers to this fund, which is a managed futures fund not available in the UK, but the reason why he chooses it is because it can go both long and short. That means that overall it's usually uncorrelated with the 60/40 portfolio. Also, in the past, it generated pretty good returns. Now, a managed futures strategy is special because the fund managers can go both long and short, so in theory they should be able to make money in a rising market or a falling market. So in the description of the fund, you can see that it says that it seeks to perform regardless of the direction of equity markets, and that's very important. And you can see that flexibility from the fact sheet. This is of course a snapshot at a point in time. It will vary depending on when you look at the fund. But there's a combination here of treasury bills, but also gold, S&P E-mini futures, and also notice that there's negative exposure because they've gone short via the futures market as well. So here they're short Euro FX currency futures, US 10-year note futures, and so there'll always be some long and short components of the portfolio. And assuming that the fund managers get the direction right, then this fund could generate pretty good performance long term. But because we don't have access to managed futures funds in the UK, at least as far as I know, then that's why the illustration we had previously used a combination of gold and broad commodities. If we look at the correlation of those two with the 60/40 portfolio, you can see that they're both quite low. For broad commodities, the correlation was about 38% over this 20-year period, and for gold it was even lower. So whatever you choose, it should have that low correlation, and that reduces the list a lot. If you're thinking some kind of fun equity portfolio, remember that that will be correlated with the equity component of 60/40. So what I'd stress is it's not easy to find an investment which has that combination of good long-term return and low correlation to 60/40. the choices are very restricted. Now, as with anything, things can go wrong. So what might that be in this case with return stacking? Well, it assumes that when we stack a return on 60/40, what we're adding is going to increase return, that it's going to be a positive real return. Well, that might not work. What we've chosen for our additional investment, what we're stacking on top of 60/40, may underperform, or it could even have a negative return over our investment horizon. Another problem might be that we get a repeat of 2022 when we get a huge inflation spike and the leverage 60/40 exposure really hurts us as both equity and bonds fall together. Now, of course, the size of that fall, because we've only got 2/3 of our portfolio invested in the levered fund, won't be as large, but it'll still hurt. And that'll be particularly true if the third point comes true and the correlation of our investment magically picks up during that falling period. We might have chosen something which historically has had a low correlation to 60/40, but correlations can change over time. If the cause of the fall in equity and bonds is also affecting our return stacked investment, such as gold, then it could be that we have a very significant fall in our return stacked portfolio. I have to say that's unlikely, but it is possible. So I hope that's introduced you to the concept of return stacking. Now, as always, do your own research. This isn't a recommendation that you go out and try it for yourself, but I certainly think it's an interesting approach to investment. It's not about taking crazy risk because remember you've dialed down the amount of leverage 60/40. It's really more about making more efficient use of your capital using leverage. Now don't forget, if you did want to learn more about that Wisdom Tree Global Efficient Core ETF, there's more information available in the description below. You'll find a link there. And, as always, thank you for listening.